Start the old recording. Can everybody hear me all right? All right. All right, sorry, I'm running a little bit late. One of those mornings. All right, so a few announcements. First of all, some of you emailed me and had issues with the retake of quiz 1. And so keep in mind, whether you are pleased with your quiz 1 grade or not, you get an opportunity for a retake for a little bit less points. I think, the quiz is worth 25 points. You can retake it for 21 and a quarter points, like 80% or something like that. Some of you had Proctorio issues, and I think that was a settings issue. And so what I've decided to do is I've reopened, I think it actually reopens at noon today. I've reopened the quiz 1 retake. You're welcome to take it. Like I said, if you're happy with your grade on quiz 1, then you can keep that grade. If you're happy with your quiz with your grade on quiz 1 retake, first try, you can keep that. Or you can keep this one. I'll take the highest of the 3 grades, okay, if that makes sense. So there's no risk in doing that. Again, you can use your book, notes, whatever else. But some of you had technical issues, and some of you had, just issues in kind of putting together the knowledge and stuff like that. So, getting into these multiple choice types questions is going to be very valuable. All right. So everybody okay with that? Everybody good there? And again, that will be in McGraw-Hill Connect. So should open up at noon today. And I think you have till Thursday at noon. I think you got a couple of days to do that. So if you're interested in retaking the quiz, you can do so there. All right. What else? Excel project. Due tomorrow. I think it's due tomorrow. So hopefully everybody's done that, downloaded it, and worked on it. I've told a lot of students, this is a project that everybody in this class is going to have a wide range of Excel knowledge, and so this is to introduce you to Excel. So I don't really have a problem, because everything's so individualized. Your numbers are going to be different than anybody else's. If you get stuck, I have no problem with you posting, questions in our D2L chat or anything of that nature. So I encourage you to, you're welcome to kind of, do your own work, but work together on this, okay? And pack back questions. Hopefully everybody's posted, and we'll need responses on those by Friday. Okay? What questions do we have? Everybody good? Because I'm just doing such an awesome job teaching, learning. By the way, if you go to Connect, and I encourage you to do this as we enter into the final chapter before exam 1. In Connect, there's a folder with a lot of multiple choice questions. So chapter 1, 2, and 3, a lot of multiple choice questions, and those are going to be really good for practice. Again, kind of doing the homework, going through the homework, and then applying that into a multiple choice setting is a very valuable skill. Raul, you got snow up there, man? How's the weather today? All right. I'll wait for Raul to wake up or stop throwing snowballs. Oh, man. Oh, man. man, I can imagine. Like it's just kind of been, ooh, dreary here. If it's gonna be cold, I'd soon have snow. But all right, so today we're going to shift our focus again. You know, the accounting equation and all of our entering transactions into the grid that we've kind of done ad nauseum now is that's the foundation for accounting. And all we're going to do is we're going to enter in different situations. Okay, so what we've done up to this point is really kind of looking at entering those transactions for really more service-oriented companies. And, just to kind of give you a framework, like the way to think about that is a lot of the entries that we learned in Chapter 2 has to do with, maybe an attorney or an accountant or consulting, where you're not really selling things, you're providing services. And that's very important because, we've talked about, the revenues are inflows of assets from doing what we do. So doing what we do in those settings is going to be, providing legal services, providing accounting services, providing consulting services. And so, our definition of revenue depends on, what type of business we're dealing with. In Chapter 3, what we're going to do is we're just going to introduce this. Okay, how do we deal with these transactions when we deal with a merchandising company? So you just got to kind of shift your thinking. And a merchandising company is any company that sells a product. So you think Walmart or a bakery or anything of that nature is a merchandising company. And so we're going to deal with the how to account for those businesses as we get into Chapter 3. So again, today's going to be really much more of a lecture day. On Thursday, we'll get into doing tons of problems associated with this. All right, so I'm going to share my PowerPoint for Chapter 3. All right, so accounting for merchandising businesses. And here we have the income statements for AutoNation, and these are partial income statements. A couple of things I want to point out: if you've never seen a financial statement before, usually financial statements don't read like a book. You have comparative financial statements, which means you have more than 1 year's worth of information. However, the most recent year's information is usually the furthest left. Okay, so it's the one that's closest to that. Okay, so generally the most recent year is going to be the left, and then it'll get further away. So you can't really read it like a book, from left to right. Okay, but if we look at AutoNation, revenue is the income statement is simply revenues minus expenses. Well, revenues is inflows of assets from doing what we do. Well, as to be expected, AutoNation sells new vehicles, and they sell used vehicles, and they provide parts and service. But AutoNation also provides financing, right? So if you go to AutoNation and you want to buy a car and you don't have the cash to put down, then they'll finance it for you. Okay, so now our total revenue is broken out a little bit into the different categories of things that we do as a company. We also have here a cost of sales. Okay, and we're going to really talk. We're going to talk a lot about this in Chapter 3. This is one of our new entries. But the cost of sales for new vehicle, used vehicle, parts and services, and other. This is really like our inventory costs, okay? And so we'll talk about that here in just a bit. This is an extremely important term that you're going to learn: gross profit or gross margin. Those mean the exact same thing: gross profit or gross margin. But what that is the revenue that you earned after accounting for the cost of sales. Okay, so as we get a little further into the chapter, we'll see how this really makes sense. So again, at the end of the day, the net income of AutoNation is the final product of the income statement. You also have Ford Motor Company. Again, Ford Motor Company, automotive sales, financial services, so on and so forth. All right. So they were just kind of comparing and contrasting these. Again, the end product of the income statement is net income. You might say, hey, what is this net income attributable to non-controlling interests? Well, come see me in 2 years when we take advanced accounting, and we'll talk more about that. It's pretty much awesomeness. Merchandising businesses, they generate revenue by selling goods. So what they do, the revenue is inflows of assets from doing what they do. They buy merchandise and they sell it from companies called suppliers. They buy the merchandise from companies called suppliers, right? So, Walmart buys, whatever, peanut butter from Smucker's, and then they turn around and they resell it. The goods that they purchase for resale are called merchandise inventory, or just simply inventory. Okay, I'll typically shorten that to inventory. Merchandising businesses include retail and wholesale companies. It's easy for us to kind of visualize in our mind retail companies, Walmart, bakeries, anything of that nature. Kind of hopefully makes a lot of good sense. Product costs versus administrative costs. This is kind of a silly distinction. Hopefully this will just make sense. This isn't something like that's a major emphasis that you need to learn, but product costs are the costs incurred to acquire merchandise and get it ready for sale. So, if we're a bakery or we are, we're a bakery that sells cakes. Well, there's a specialty cake over in Alpharetta that we want to sell in our store. Then a product cost would be the cost for us to buy that cake, as well as to pay to have it shipped to us. Okay, so those would be product costs. Selling and administrative costs are costs that are not included in inventory, also called period costs. This would be like the insurance that we pay, or the salaries that we pay. These aren't related to inventory at all. They're related more to a time period. All right, so we're going to record and report on inventory transactions using the perpetual system. Perpetual means ongoing. Okay, so these are inventory transactions that where we're tracking our inventory kind of immediately on an ongoing basis. So you look at this and you're like, oh my goodness, we got another thing to learn here, another equation to learn. But these are like really silly. Like don't make these like harder than they need to be, because all they're doing is they're adding a picture to common sense, right? Our beginning inventory plus inventory that we purchased during the period equals cost of goods available for sale. Okay, let me explain. We're a cake shop. We buy all of our cakes from a specialty shop over in Alpharetta, and we resell them. So at the beginning of the month, we have 1 cake available for sale. We drive over there and we buy 10 more cakes. How many cakes do we have available to sell? 11, right? So that's all we're saying. And with our inventory, we're really gonna track 2 things with our inventory. We're gonna track quantity and value. So if the 1 cake that we had was a $10 cake, and we bought 10 more that were each $10 cakes, then we would have 11 cakes for sale, but the cost of those would be, whatever, 110, right? So each one costs $10, okay? Now, let's drop down to this other little tricky chart here. Let me tell you what this chart says. Everything that you had available to sell, those 11 cakes, you either sold it, cost of goods sold, or you still have it, which is inventory. okay? And that shows up as an account on the balance sheet. What type of account do you think inventory would be on the balance sheet? Asset, liability, or equity? Asset, right? And, what's our definition of an asset? It's something that we own or control. We can do whatever we want to with it, right? After we buy those cakes, we've got 11 cakes available to sell. Well, we could take that cake and split it up and have an office party. It's, we can do whatever we want to with it. So that's why our inventory is an asset on the balance sheet. I mentioned this before, gross margin or gross profit. This is the difference between sales revenue and the cost of goods sold. This is a very, very important term right here. Now, and if you think through it, it makes sense because if a friend of yours comes to you, I'm using cakes. I don't know, I must be like extremely hungry or something for cake. But if a friend comes to you and says like, hey, I'm going to open a cake shop. I know that I can sell my cakes for $10. The very first question you're going to ask is, okay, how much does it cost you to make them, right? Because if it costs $4 to make a cake, which it would be the cost of goods sold, and you can get $10 for it, then my gross margin is 6. And so what that says is, okay, you can make money, you can earn revenue from doing what you do. If they tell you can, that they can resell cakes for $10, but it costs them $11 to buy it, your gross margin is -1. That's a dumb idea, right? You're going to walk away. You're going to say like, hey, don't do that. That's a silly idea. So gross profit is where we apply accounting to kind of a decision-making tool, and say, it's a decision tool to see, is this business worth pursuing? Okay. Net income, in net income we know is revenues minus expenses. All we're doing here is we're dividing our expenses into product cost, product expenses, which is the previous slide. Sales revenue minus cost of goods sold. Cost of goods sold is all of our product cost, and selling and administrative costs is all of our period cost, right? So after your friend, after we determine that your friend can sell cakes and make $6 per cake, you can say like, hey, that's great. It sounds like you got a reasonable business plan. However, it costs money to run a business, right? You need to get insurance. Like if somebody eats your cake and gets sick, you could be liable. So you got to make sure that you have insurance. You got to pay people. You got to have delivery people. You got to have an office. You got to have a bakery. All these things are included in there. And if after all of those selling and administrative expenses you make net income, then you can say like, hey, you know what? Sounds like this might be a viable business. All right, so a perpetual inventory system is where the inventory account, and again, the inventory is going to be an account. It's going to be a column under the assets that is perpetually adjusted throughout the accounting period. Okay, kind of makes sense, where the inventory is increased for each item purchased and decreased for each item sold. If you think about it in terms of Walmart, when you go into Walmart and they make you, go through there and use the gun to scan your own items. Beep. Every time you buy that piece somewhere in Bentonville, Arkansas, their inventory account goes down. They've made a sale, and so their inventory account goes down. That is a perpetual. It means it's constantly adjusted throughout the accounting period. This happens a lot in retail stores, and so it's kind of easy to track. So let's look at some transactions where we're adding a few new columns. JPS acquired $15,000 by issuing common stock. A couple of terminology points that hopefully you're picking up on right now. Issue means to give. So when JPS issues common stock, that means they give someone common stock right there, and they get $15,000 cash, okay? And this is a Chapter 1 transaction. This is a financing cash flow, okay? We've seen that several times, Chapter 1 and Chapter 2, maybe just Chapter 2, but no problems there. Now, what do we do with that cash that we received? We purchased merchandise inventory for $14,000 in cash. Well, you know, the whole reason that we have a business is to try to, you know, add value, create value. And merchandising businesses do that by buying inventory and then reselling it. So we're going to take that, we're going to take that cash and we're going to exchange it for inventory, merchandise inventory. Okay. So that's just an asset exchange transaction. Doesn't affect the income statement. And this is not revenues or expenses. This is just us preparing to do our business. That goes on the statement of cash flows. Remember, to be classified as an operating, investing, or financing activity, you have to have something in this column. So in that column, we have a negative $14,000 cash. That is an operating cash flow. Cash flows for doing what we do. Recognized sales revenue from selling inventory for $12,000 cash. Okay. Now for merchandising companies, our sales transactions are going to be a little bit different than consulting, because we have two things that happens. You know, when we do consulting work, we just simply do the work and we receive the revenue, you know, whatever the asset is. But in this case, two things happen. We sell inventory, so we receive cash, and that is revenue. That is an inflow of assets from doing what we do. We sold the inventory, so the earnings process is complete, right? You know, we talked about that in Chapter 2. You know, from a legal standpoint, you only earn revenues when the work is done. In this case, we earn it when the sale is made. Okay, so we're going to recognize the asset and we're going to recognize the revenue. So great question, Sydney. And so let's talk about that. That's the second part, right? Because one thing that happens is that we earn the revenue. However, Sydney pointed out, which is absolutely correct, inventory goes out the door, right? Now, here's where we recognize the inventory going out the door, okay? Now, and Sydney, your question is a valid one, right? What we're going to do is we're going to recognize the cost of the goods that we sold. Now, the difference between the sales price and the inventory right here is, you know, that's why we're in business, right? So inventory is going to be reduced at the cost, like whatever we paid for it. So like if we bought, you know, in my silly example, if we bought cakes for $10 a piece, so I had one cake in inventory at $10, and I sold it for $20, I would reduce my inventory by $10 because that's the value of the inventory that I sold. However, I would earn revenue of $20. So the difference between the revenue and the expense would be $10, and revenues minus cost of goods sold is what? What definition have we learned today that would be revenues minus cost of goods sold? Gross margin or gross profit. Very good. Does that make sense? Sydney, does that help? So keep in mind, for merchandising companies, revenue transactions are going to be two-part entries. You're going to record the revenue and you're going to record the cost of goods sold. Everybody with me? Is anybody with me? All right. Hang in there. Stop me if you got questions, all right? Notice this transaction it doesn't affect the statement of cash flows, because all we're doing is it's kind of like our supplies, right? We're showing that we consumed the inventory. We consumed it because we sold it. We got rid of it. And that becomes an expense. And that expense is called cost of goods sold. Cost of goods sold is the only one that has a kind of a non-intuitive name, account name. Cost of goods sold is equivalent to like inventory expense. Paid $1,000 cash for selling expenses. That maybe this is delivery or whatever. Cash goes down, expenses go up, which causes net income to go down. That is an operating cash flow. Doing what we do. Paid $5,500 to purchase land to locate a future store. This is buying the infrastructure, so that's an investing cash flow. Our cash goes down, an asset called land goes up. That doesn't affect our income statement at all. Okay. There we have our financial statements. The income statement. Revenues minus cost of goods sold. That was our sales transaction. Gives me gross margin of $4,000. Okay, that's pretty good, but it costs some money to operate a business, and those selling and administrative expenses. We arrived at net income of $3,000. Okay. Notice that at the end of the period, we still have inventory of $6,000 because we bought inventory of $14,000. We sold $8,000 of it, so our ending balance in merchandise inventory is $6,000. Does everybody follow me there? We didn't pay any dividends, so the net income simply becomes my retained earnings. And there we have our assets, no liabilities, and equity. Okay? All right. So that's the foundation of what we're doing. Hopefully, we're just introducing a few more terms, a few more accounts. All right, so purchasing inventory often involves returning inventory or receiving purchases allowances. This has actually been really funny. We as consumers, we relate to businesses, even though these analogies kind of break down, right? But businesses oftentimes maybe they buy something, buy lumber or something, and then say, you know what, we bought way too much lumber, we'll return it. Okay. Purchases allowances. This has been really fascinating in pandemic world. We saw some friends yesterday, and we were just comparing stories. And I don't know if you guys have done this, but because of pandemic, a lot of things you buy online right now, if they don't fit or you don't like them or whatever, my wife has done this a lot. She's gone online to return it, and they say like, oh, just keep it, donate it, or whatever you want to do, because the cost of taking it back is greater. They couldn't resell it, or it's contaminated or whatever else. So that's a purchase allowance. A purchase allowance says like, hey, what if you paid $100 for this, but what if we give you a $50 refund and we just call it good? That's a purchase allowance. Purchase discounts are something different. Purchase discounts are typically like volume purchases, or if you buy 1,000 pieces of lumber, you get a different rate than if you buy 10. Or it could be cash discounts. Okay, so think things like this. Transportation costs. Sometimes you got to pay shipping, sometimes you don't. And then recognizing inventory shrinkage. It's pretty funny, but inventory shrinkage just means like if you ever follow my family around Walmart, you would, and again, hopefully, as you take accounting, you begin to view the world differently, right? Because invariably, we are going to break something as we walk through Walmart, right? We have too many hands on things. So what happens when you break something in Walmart? And, the inventory goes away, but, they just kind of like, don't worry about it. So I always think about inventory shrinkage. And by the way, I should tell on myself because I try to blame it on my kids. My wife and I were in Dallas, Texas. We were in Whole Foods. I actually ran into the wine display in Whole Foods in Dallas, Texas, wiped it out, and they were very gracious, but all I could think was, that's a pretty large inventory shrinkage. But yeah, so that's what inventory shrinkage is. Whew, boy, that was a rough day. I tried to blame my wife, but she was too far away, so I kind of got caught red-handed. All right, year 2, and some people have had questions, about this. We haven't done a lot of problems that span multi-years, but we had the financial statements for JPS, but JPS kind of keeps operating. So in the second year, we've got some more events. JPS borrowed $4,000 cash by issuing a note payable. So that's a liability, and cash goes up. That is a financing cash flow. JPS purchased on account merchandise inventory with a list price of $11,000. So keep in mind here that our words really matter. They purchased on account merchandise inventory. So we bought merchandise inventory that cost $11,000. Boom, that goes up, kind of easy to see. Accounts payable. Accounts payable are primarily associated with inventory transactions. This is running a tab on inventory transactions. You go buy, if you resell dirt, you go get a dump truck load of dirt, and you say like, hey, just give me the invoice and I'll pay you in 30 days. Okay, that is on account. So we'll talk about how purchase returns and allowances affect financial statements. This is actually like so common sense. This is why don't try to get hung up on things like the terminology. But no, Tawana, no set amount of accounts under assets, and that's why a couple of things to address that. Let me point out that, and by the way, that is a world record. I was wondering where you are. You have gone 40 minutes into class with no communication. I don't know whether to be hurt or happy, but welcome. I mentioned you'll never see an account title that we haven't talked about in class or homework. Okay. And so what you're going to know is if you're doing this on pencil and paper, right? You'll know okay, we've covered, we've only covered 2 types of liabilities. So you'll know oh, okay, I need to leave myself enough room for 2 or 3 columns under liabilities. Equity, there's only 2 columns. Assets, the assets, you just need to leave yourself for 5 or 6, right? So, well, yes, welcome. So, JPS, they bought some inventory on account, and they said, hey, you know what, we bought too much, or we didn't need that much, or we didn't need that color, whatever. They decided to return it. The list price of the returned merchandise was $1,000. Well, when we return it, what do? Inventory goes down and accounts payable goes down. This is just like, going to Walmart or Target and saying hey, you know what, I decided I didn't like this shirt. And they say, okay, we'll put it back on your card. Your credit card bill goes down. The amount that you owe on your credit card goes down, and your shirt inventory goes down. Okay? Purchase discounts. Now, purchase discounts are a little bit tricky, but I'm an awesome teacher, so I can help you. I can help you learn this. Just kidding. Purchase discounts are granted to try to get your customers to pay early. Okay, And so like if the sale is made right here, so you go into Office Depot and you buy all your office supplies right here. What they'll do is they'll say like, hey, if you pay us if you pay off your tab in 10 days, we'll give you a discount. So the discount period would be 10 days, and then they'll specify some sort of discount, 1%, 2%, 3%, whatever. After 10 days, then you got to pay the full amount. And we'll see how that's written. This is accounting shorthand, okay? JPS received a cash discount on goods purchased in event 2. The credit terms were and this is how you read this right here. Credit terms are going to be expressed just like this, okay? And the way to read this is 210 net 30. Everybody say that with me, even if you're at work. 210 net 30, okay? What this means is, and again, you're going to see this. This is just two terms. What this says is this first number specifies the discount period, 10 days, and then the discount amount, 2%. So if you pay me within 10 days, I'll give you a 2% discount. The comma says, otherwise, you got to pay everything within 30 days. So when you go buy something, your basic terms are like, hey, you need to pay me every 30 days. But if you pay me within 10 days, I'll give you a 2% discount. Okay, everybody with me there? All right, cool. So let's look at, here's what's a little bit tricky. How much do we owe? What's our accounts payable? Well, remember we bought $11,000 and we returned $1,000, so we owe $10,000 on our purchases. If we take the 2% discount, then that means that's a $200 discount. All right? So the very first thing we're going to do is we're going to record the discount. And the way that we'll do that is we will reduce our inventory by 200 and reduce our accounts payable by 200. Now, everybody try to fight me on this. Tell me your problem with this transaction right here. Thank you, Tawana. You didn't fight me. You just questioned me. Why do you say, huh? It's okay to fight me. It's been one of those weeks. Why would we reduce the extra 100? What you talking about? 200? So this is our discount, right? 200. 2% of 10,000 is 200. So we're going to get a discount of $200. So we're going to reduce our accounts payable, and we're going to reduce our inventory. Does anybody have problems with this transaction, like that we're reducing inventory specifically? Oh, it's 2%, Twan. 2% of the very good. Nisha, do we have to return 200? Yeah, so we still have the inventory. All right, I'm liking the discussion. At the end of the day, let me go back to what Nisha said. We received 10,000, but we have to return 200 as a discount. And then Sydney says we still have the inventory, right? So we didn't get rid of any inventory. So why are we reducing it? And we didn't lose 200. We actually kind of gained 200, right? We didn't have to pay 10,000 for it. We actually paid 9,800, and that's what we're getting at right here. Okay, like if you buy a house for $100,000, and well, this would be this could be in any case, Tuan. And all this is a discount for early payment, right? So if you think about it this way, like if you go to, like, sometimes we go to the farmer's market, right? When you go to the farmer's market and they say like, okay, the price of this, the price of this bushel of corn is $12. If you pay by credit card, it's $15. So if I pay by credit card, my inventory would be $15. But if I pay with cash, my inventory would be $12. So what we're saying is, because I paid early and I took this discount, I didn't have to pay $10,000. I only had to pay $9,800. So that's taking my accounts payable to $9,800 and my inventory. Does that make sense? Does that help? We're not changing the quantity of inventory. We're changing the value of inventory. We're like what we paid for it. Well, we've already recorded 10,000, right? Yes, we recorded inventory of 10,000 and accounts payable of 10,000. So now we're reducing that. We're like, nope, it's not 10,000, it's 9,800. And our accounts payable is 9,800. So that's what we're doing on this purchase discount. Because we've got 900, like what we're getting at is 9,800. Let me go back up. So we bought 11,000 in inventory. We returned 1. So now my balance is 10,000. And we get a $200 discount. So we subtract 200. So now my total is 9,800. So the 9,800 is, yes, so the 9,800 is our running total. Tawana, no, it's not always 2%. It's going to be whatever this number is right here, right? So if you pay within 10 days, you get a 2% discount. Otherwise, you got to pay me within 30 days, the net, everything. This could be 115. We returned 1,000, Guadalupe. Right here, we returned 1,000. Does that make sense? So we bought 11. Bought 11. Yeah, returned 1,000, and then took the discount. So it'd be, whatever your balance is. Is what a shortcut, Tawana? This right here. Yeah, this just defines your terms. Like, all businesses operate under, when they're doing businesses with other businesses, they have credit terms. So when Lowe's buys from Georgia Pacific, all the lumber that they buy has credit terms, 2, 10, and 30. That would mean that if they pay within 10 days, they get a 2% discount. It could be 115. Whatever you negotiate, these companies work this out together depending on their cash management needs. So we're going to reduce our liability and our inventory because we didn't pay 10,000. Now we only paid 9,800. And Sydney, this might help you a little bit as well. We paid the 9,800 balance due on the accounts payable. So our accounts payable is sitting there at 9,800, and we fully pay it off in the next step. And I'm with you. And sometimes I accused you of this yesterday. I think a lot of times we try to make it way too hard, right? Because it really is like probably a little bit more basic than what people try to make it. I know, like in the past when we've had face-to-face meetings, I've always told my intro classes, like, what's your objection to intro accounting? What horror stories have you heard? And one of the biggest ones is like, oh, I can't do math. And I told the lady that cut my hair a while back, I was like, so if I gave you a big pile of money, you don't think you could count it? Would you be like, hey, I can't do math? And she was like, no, of course. And so she cut my ear off. No, I'm just kidding. But yeah, I mean, the math that we do is actually pretty simple. It's just using the logic, applying the logic to where you're like, oh yeah, that makes sense. So that's our goal before exam 1 to get there, right? Transportation costs. Here's another term, and again, these are just business terms that companies use when they do business with each other. Okay, 2 terms, and I'm gonna explain it legally, and hopefully it'll make sense. But you're gonna see this. So like, when Lowe's buys lumber from Georgia Pacific, what they do is they have credit terms. So we're going to buy lumber from you, and our terms are going to be 2-10-N30. And hopefully, after today's class, you'll know what that means. That means we get a 2% discount if we pay within 10 days. Otherwise, everything's got to be paid within 30. And it also specifies FOB shipping point and FOB destination. Okay. And what this does is we use it from an accounting standpoint, but this is really more used from a legal standpoint, okay? FOB shipping, FOB shipping point says that the seller is going to be responsible for the goods up to the shipping point, okay? So if it's FOB shipping point, that means the buyer is responsible for paying the shipping. FOB destination says the seller is responsible for the inventory until it gets to your place. Okay. Now let me give you an example. Like, skip all of this, right? Let's say that we're buying a product from England. Okay. And you buy this product from England and they have to ship it to you, like literally put it on a ship. And so that company says, okay, here's our terms. Let's say you're buying a Rolls Royce. You buy the car for $100,000 and our terms are FOB shipping point. What that means is that Rolls Royce is going to have your car delivered to the boat. And if you want it, then what you got to do is you better call the shipping company and tell them, hey, here's my payment and here's where I want it delivered. So FOB shipping point means the seller's saying, hey, I'll take it to the shipping point. In another, like, maybe a simpler example is, I'm gonna send you your product, FOB shipping point. That means I'll take it to the UPS store, but if you want UPS to get it to you, you better pay for it. Okay. Now, here's why it's a legal term. Okay. If that company, if Rolls-Royce sells you a car FOB shipping point, they take the car to the shipping place, puts it on the boat sinks, I'm responsible for it. It's my loss. Okay. If I'm the buyer. FOB destination says the seller is responsible for getting it all the way to the destination. Okay. So if you buy a Rolls Royce and they say our terms are FOB destination, that means like they're going to take the car to the boat. They're going to make sure it gets on the boat. They're going to pay for it to be shipped all the way to your house. And if that boat sinks, they're responsible for it. So FOB means free on board shipping point and free on board destination. So those are 2 terms you need to understand. And again, the easiest way to understand it is, FOB shipping point means the seller is going to take it to the shipping place and leave it. FOB destination, they're responsible for getting it all the way there. The shipping terms of the inventory purchased in event 2 were FOB shipping point. That means we bought some stuff and it was FOB shipping point. That means the seller only sent it to, all they did was take it to the trucking company. We had to pay the freight company $300 for delivering the merchandise. Here's what's important about this, okay? We're going to pay cash of $300, and our inventory is going to go up by 300. Okay, this is not an expense yet. This is a product cost. What this means is, it's very similar to our discount. We didn't have to pay, $9,800. We actually had to pay to have shipping as well. So we actually paid, $10,100. So when we have to pay shipping to have it delivered, those become product costs. They increase the cost of our inventory. Okay? We recognized $24,750 of revenue for merchandise that cost $11,500. Remember, this is going to be a two-part transaction now. We're going to record the cash. Inventory is increased by 300 because we had to pay that 300 to get the inventory or the car, right? Like, if I sell you my, I used to talk about this, if I sold you my Super Bowl ticket, and I said, hey, I got a Super Bowl ticket, I'll sell it to you for $100. And you're like, hey, that's great. That sounds like a great deal. And I say, oh yeah, by the way, you got to pay shipping, and to get it to you in time, it's $10. So what would you say you paid for the ticket? 100 or 110? You paid 110 for the ticket, right? Because you paid 100 for the ticket and 10 to get it. So in order to actually get the ticket into usable place, you had to pay 110. So that 300 of shipping actually becomes a cost of our inventory. Okay? So two parts of sales now. We're going to recognize revenue, and we're going to recognize the cost of goods sold. So our inventory goes down, and that is cost of goods sold, an expense, which reduces our retained earnings. JPS paid $450 cash for freight costs on inventory delivered to customers. This is inventory that we sell to other people, right? So if we have to pay that, that's just a selling expense. Okay. Paid $5,000 for selling and administrative. That's a transaction we've seen quite a bit. Paid cash for interest expense. Interest expense is, something new. It's a new type of expense, but it's not something that we're totally unfamiliar with. Interest is just the cost of borrowing money. So anytime you have a note payable, bond payable, mortgage payable, you're going to incur interest expense. So that the interest that we have to pay is recorded here. Show how inventory shrinkage. We talked about this, but these are decreases in inventory for reasons other than sales to customers. It means it could be stolen, damaged, lost, or misplaced. So kind of talked about that. Took a physical count of inventory, found 4,100 of inventory on hand. Companies do this at the end of every year, or various periods. If you ever walk through the store towards year end, December, what they do is they actually go and they physically count their inventory. You might see tags on stuff that says DNI, which means do not inventory. There's various reasons for that, but if you look, our beginning balance was in the inventory was 6,000. And Sydney, this might help you as well to look at what our inventory consists of. We bought 11,000, so we're at 17,000. We returned 1,000 of it, so now we're at 16,000. We got a purchase discount of 200, and we had to pay transportation of 300. So the total amount of goods available for sale was 16,100. We sold 11,500 of that, so that means our inventory should be 4,600. Okay. But when we walked around and we counted, we only found $4,100 worth of inventory on hand. What happened between that and that? Well, more than likely it was either stolen, damaged, lost, or misplaced. And every company has a different policy for what to do about inventory shrinkage, right? Like I said, I mean, you know, if you've ever knocked something over in a store, most of the time that, you know, they don't hold you to it, they don't make you pay for it. They have an allowance for that, right? They know that that's kind of a cost of doing business. So what happens here is after we go around and we count and we find inventory shrinkage, we would, you know, we would decrease our inventory from 4,600 to 4,100, which is what it actually is, and we would record an expense that would reduce our net income, because this is just a cost of doing business. Gains and losses. Okay, gains and losses are different than revenues. Okay, when merchandise inventory is sold for more than it costs, the difference is called gross margin or gross profit. So anything that anything that inflows of assets from doing what we do, that's called revenue. When JPS sells land for more than it costs, the difference is called a gain. Okay, gains and losses are different from revenues and expenses. Okay, gains and losses arise from transactions that are not our core business. So JPS is in the business of, I think they sell plants. They bought land to put an office building on, and they sold it. So when we sell, sold the land that costs $5,500 for $6,200 cash. That's great, you know, and you can just kind of walk through this, right? You know, this is where it becomes a true accounting equation, right? My cash goes up by $6,200. I get rid of the land. What is the land on my books for? $5,500. What's the difference between those? It's a gain. Okay, a gain is different than revenue because this is not in the business of doing what we do. Okay, and notice this is an investing cash flow, right? Investing cash flow. You know, we bought the land to invest, to build our infrastructure. That was an investing cash outflow. When we sold it, that's an investing cash inflow. So a multi-step income statement is actually really huge because it gives a whole lot more information than a single step. I'll show you, we have an example of a multi-step income statement. And I want you to know all the steps of a multi-step income statement, but it is so logical, right? And this is an example of a multi-step income statement. Sales revenue minus cost of goods sold equals gross margin. So this is, I mentioned this before, like if June's plant shop, if June comes to you and she says like, hey, I'm thinking about starting my own business. How do I start my own business? You know, and you advise her, and she says, okay, I figure that in the first year I could sell plants and make, the revenue greater than the cost of goods sold would be $12,750. Okay, that you've kind of passed my first step. Can you kind of earn more from doing, from selling plants? But there's also some other costs involved with running a business. You have to rent a building. You have to pay transportation to ship these plants. And those are selling it in general SG&A expenses or selling and administrative expenses. When you subtract those from your gross profit, that gives you operating income. So this tells me, okay, you can earn money from selling products. That's great. Operating income tells me, okay, I can actually earn money from running a business. And then non-operating expenses are kind of these other expenses that aren't really related to what we do, like borrowing money and selling our land. So that gives us net income. But if you think about it, it's a stepwise process, right? So if you really want to see how well a company is doing, a big subtotal would be operating income right there, okay? So, you can see that most U.S. companies use the multi-step income statement. There's June's balance sheet, statement of cash flows, determine the amount of net sales. Let's see real quickly. Well, I'll tell you what. I'm gonna stop right there. Okay, we'll pick all this up on Thursday. I did want to. So for those of you that joined late, keep in mind I think it's open now. The quiz 1 makeup is available for you to retake. Whether you did well, whether you did poorly on quiz 1, I encourage you to take that. I will take your highest of the 3. So quiz 1 retake, or this one, because some of you had technical issues with that. So I want to give you another chance to do that. Packback and Excel are also out there and available. So I strongly encourage you to not forget those. Okay. What questions do we have? I encourage you to keep practicing. A lot of this is gonna just take practice to become second nature. Reach out to me if you have any questions. I'm still trying to figure out. I think we may have some teaching assistants that might be able to provide some office hours as well. Okay. So anybody got questions? Yes, that's correct. You just need 1 question and 1 response. So again, we got, you can do more than 1. That's certainly fine, but 1 required. All right. If there's no other questions, that's all I got for today. So I'll hang around if you want to talk about Tom Brady or